Welcome to Market Pulse by Resties Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Wednesday, August 5, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
So looking at today's proprietary data deck, we've really isolated three critical themes to guide you through the noise today.
Right, because there's a lot of noise.
Yeah, exactly. First, we are tracking a severe stagflationary undertone in today's macro data. And, it's creating intense policy uncertainty under the new Warsh Fed.
Which is a major shift.
It is. Second, we're seeing this massive capital rotation underway. It's happening right beneath the surface of a completely flat index. Money is just flooding out of U.S. mega-cap tech and into defensive assets right alongside a powerful surge in Asian equity markets.
Yeah, and third, we'll be analyzing that explosive multi-factor breakout in gold, coupled with the crude oil sell-off driven by the developments in the Strait of Hormuz.
Right, it's a glaring paradox, honestly.
Yeah, why does physical gold just explode 4% to the upside on the exact same day that global crude oil prices completely collapse?
That's the big question.
So let's start with the macroeconomic foundation. Because the conflicting economic data we received today is directly driving the U.S. Treasury market. It's fundamentally reshaping how institutional capital views the interest rate trajectory.
Yeah, looking closely at our daily desk data, the headline numbers are, well, they're masking a highly troubling reality for the broader economy.
They really are.
We got the ISM services index today, and it beat expectations, coming in at a level of 54.1.
Right, and on a surface level, any number above 50 signals an expansion.
Exactly. It looks like the services sector of the economy is just humming along perfectly. However, when you dig into the internals of that report, it presents a very clear, undeniable stagflationary undertone.
So, let's pause and unpack those internals for you listening, because the details here are completely contradictory to the headline.
There they are.
The prices paid component of the ISM report just spiked dramatically to 70.3. Meanwhile, the employment subindex actually contracted, dropping down to 47.4.
And that is the core of the problem right there.
Huh.
The prices paid metric measures the inflation that businesses are actively facing to acquire the materials and services they need.
Right.
A spike to 70.3 means the cost of doing business is just surging rapidly.
Right.
And simultaneously, that employment drop to 47.4 means businesses are actively shrinking their workforces.
So they're paying significantly more for their inputs, but they aren't hiring.
Correct. And you have to immediately combine that ISM employment contraction with today's ADP employment miss.
Which was a big miss.
Huge. The ADP report, which tracks private payrolls, showed only 44,000 jobs added for the month. That drastically missed the 65,000 institutional consensus. So we are seeing consumer and wholesale prices accelerate at the exact same time that hiring stalls out. And this data combination immediately triggered hawkish commentary from Fed Governor Cook today. She explicitly stated she is ready to raise rates if inflation doesn't slow down.
This means the market is suddenly forced to digest the very real possibility that the Federal Reserve may have to hike interest rates straight into a cooling labor market just to fight off sticky inflation.
Yeah.
And that tension is highly visible across the rate moves today.
The bond market is reacting violently, frankly. The two-year yield currently sits at 4.185%. Well, the 10-year yield has moved sharply up to 4.617%.
Right, and because the long-term yields are rising faster than the short-term yields, the 10-year, two-year yield curve has steepened significantly.
Yeah, it's up to positive 43 basis points. What we are witnessing on trading desks right now is a rapid rise in term premia across 10-year treasuries.
Okay, so let's apply the first principles rule here, because the mechanics of the bond market ultimately dictate the pricing of every other asset class. For regular investors, how does a steepening yield curve and a rising term premium actually impact a standard 60-40 portfolio, as well as everyday borrowing costs?
Well, it is the most important question for anyone managing capital right now. The term premium is essentially the extra yield or compensation that investors demand to take on the risk that interest rates might change unexpectedly over the life of a bond.
Right.
Under the current Warsh Fed framework, the market is simply no longer confident that it can predict the central bank's reaction function. Because institutional investors feel this profound uncertainty, they're demanding a much higher premium to lock their money away for 10 years.
So if you're holding a standard 60-40 portfolio, a rising term premium is highly problematic, right?
Indeed. Typically, government bonds act as your portfolio's shock absorber. When equities fall, bonds usually rise to catch you. But when term premia rise specifically due to inflation fears and central bank policy uncertainty, the bonds lose value at the exact same time your equities do.
So the fundamental diversification benefit just breaks down completely.
Exactly. And as for consumer borrowing costs, everyday debt like 30-year fixed mortgages and long-term corporate borrowing rates are tied directly to the 10-year Treasury yield, not the overnight rate that the Fed directly controls.
Right.
Even if the Fed decides to hold short-term rates perfectly steady, a rising term premium in the bond market makes buying a home or funding a corporate expansion significantly more expensive.
Moving to today's data, we can see exactly how these rates are forcing a massive rotation in the equity markets.
Yeah, we really can.
With the rate curve steepening and inflation data proving sticky, institutional capital is aggressively repositioning beneath the surface of a market that looks deceivingly calm.
The headline index is incredibly deceiving today. I mean, the S&P 500 closed essentially flat at 7,723.
Right, but according to our latest run, the index is being held tightly in place by a massive long gamma pin between 7,650 and 7,750.
Let's actually translate the mechanics of a gamma pin for you listening. Think of market makers and dealer desks acting like a giant automated thermostat for the S&P 500. When dealer desks are in a long gamma position, they dynamically hedge their options books by selling equities whenever the market rallies to the top of that range and buying equities whenever it dips to the bottom.
So they are chemically suppressing market volatility, effectively locking the index inside a tight little box.
That is an accurate description of the mechanics, yeah. But underneath that lid, individual sectors are just boiling over.
Yeah.
Beneath that suppressed volatility, a massive sector rotation is actively occurring. Capital is flowing aggressively towards safety and tangible assets.
Healthcare led the session today, closing up 1.27% right alongside materials, which climbed 1.23%.
Right. Investors are just looking for reliable cash flows. Conversely, energy lagged heavily, dropping 2.07%, and the broader technology sector suffered a painful 2% decline.
And the specific corporate movers within that technology decline tell a very specific story about how institutional capital is reevaluating artificial intelligence infrastructure.
They do.
Nvidia climbed 3% today, entirely bucking the broader tech sector trend. That divergence occurred immediately after SpaceX formally committed its entire AI infrastructure exclusively to Nvidia chips.
Cementing Nvidia's premium valuation and dominant market share, yeah.
But yet SpaceX itself dropped 14% on the day.
Yeah, that 14% decline in SpaceX is a perfect example of market mechanics clashing with fundamental spending. The drop was driven by an impending $101 billion share unlock.
Right, so when insiders and early investors are finally allowed to sell their shares, it threatens to flood the market with supply.
Which mechanically drives the price down, exactly.
Yeah.
The market had to digest that impending supply at the exact same time it digested the immense capital expenditures required for SpaceX's AI buildout.
It effectively means that while SpaceX takes a massive valuation hit to pay for the infrastructure, Nvidia just sits there collecting the toll.
Basically, yeah.
And we saw similar strictness applied to AMD today. AMD fell 7% despite delivering a genuinely solid earnings print.
The AMD price action proves that the institutional bar for AI hardware is now exceptionally high. Simply beating consensus estimates is no longer enough to sustain these extreme multiples.
Right. Investors want flawless execution and raise forward guidance. If they do not get it, they sell.
We saw similar punishment on the industrial side today, too. Honeywell dropped 14% after materially cutting its organic growth guidance,
showing that the manufacturing slowdown is really hitting the bottom line.
Yeah. However, in contrast, Eli Lilly climbed 5.3%. This was a classic mechanical market move. A highly crowded long position in Eli Lilly washed out over the past week as weak hands were forced to sell.
Right.
That heavy selling finally established a firm valuation floor, which allowed long-term institutional buyers to step back in and drive the price up today.
We also need to factor in the consumer commentary from Disney today. Disney management specifically noted a weaker Asian consumer, repeatedly highlighting spending softness in their Shanghai and Hong Kong markets.
Yeah, which is a major divergence.
It really is, because that localized consumer weakness contrasts entirely with today's massive Asian equity surge. I mean, the Kospi closed up 3.76% and the Nikkei rallied 3.66%.
It is a profound divergence. The consumer weakness Disney highlighted on the ground is simply not being reflected in the broader Asian institutional equity flows.
Right. Institutional capital is buying Asian equities aggressively despite the consumer data.
And regarding institutional flows domestically, our internal desk data reveals a massive structural shift in the U.S. markets. Throughout the month of July, TMT technology, media, and telecom hedge funds, alongside multi-strat hedge funds, suffered severe deleveraging events.
Wow, yeah. I mean, they lost 10% and 2.3% respectively across the month.
Yeah.
To put that in perspective, those are historic drawdowns for those specific fund categories. Deleveraging means these funds were forced to rapidly sell off their assets to reduce borrowed money and meet risk requirements.
Exactly. And because their assets under management shrank so violently in July, it structurally reduces their capacity to hold tech equities moving forward. They simply no longer possess the internal risk budget to warehouse mega-cap tech stocks the way they did 6 months ago.
Because the institutional buyers are stepping back, control of tech sector rallies is shifting directly away from institutional hedge funds and straight into the hands of retail options traders and leveraged ETFs.
Yeah.
Let's think about the scale of that shift for a second. If institutional hedge funds are deleveraging, the foundational tech trade is shifting from like a massive steady cargo ship to a fleet of retail speedboats. Doesn't this guarantee inherently higher volatility and a much greater susceptibility to sudden, violent market swings?
Oh, it guarantees higher structural volatility. A cargo ship, representing institutional capital, moves slowly. It's bound by strict risk parameters, diverse portfolio allocations, and long-term investment horizons.
Right.
A fleet of retail speedboats operates entirely differently. Retail options flows are highly reactive. They often move in rapid unison based on daily momentum and sentiment, rather than underlying fundamentals.
So when the market relies on short-dated retail options to drive the daily price action, you strip away the critical buffer that institutional capital normally provides.
Technical support levels become highly fragile, and daily price swings become severely exaggerated.
On that point, geopolitical shocks are exacerbating this market volatility today, particularly in the commodity space. The equity rotation out of energy stocks and into materials is directly mirrored in today's dramatic physical commodity moves.
Yeah, breaking geopolitical developments are the primary driver here. WTI crude oil dropped to roughly $75 per barrel today, marking its lowest level in nearly a month.
And based on today's proprietary updates, this sudden drop is directly tied to a Strait of Hormuz reopening trade.
Yes. We are tracking rising optimism around a formalized agreement between Iran and Oman regarding a proposed commercial shipping route through the strait.
The commodities market is aggressively pricing in the return of millions of barrels of crude oil to the global supply chain,
which instantly deflates the geopolitical risk premium that had been artificially supporting higher oil prices over the last quarter.
But alongside that crude oil sell-off, we are seeing massive opposing moves in precious metals. Gold surged over 4% today, reaching $4,247 an ounce, while silver hit $62.05.
Yeah.
This brings us back to the glaring paradox you mentioned at the start of the deep dive. Usually, a geopolitical de-escalation that sends global oil prices lower would simultaneously cool off safe haven assets. Why is gold exploding 4% on the exact same day that crude oil is heavily selling off?
Well, it's a complex confluence of fundamental macroeconomic shifts and mechanical trading factors operating simultaneously. The Hormuz shipping deal does indeed represent a geopolitical de-escalation, which fundamentally pushes oil supply higher and prices lower. But you have to track the domino effect of cheaper oil. Cheaper oil immediately reduces oil-driven inflation risk across the economy. If the bond market believes that headline inflation will cool down due to cheaper energy inputs, it immediately prices in fewer future rate hikes from the Federal Reserve.
And fewer rate hikes translate directly to a weaker U.S. dollar because higher yield usually attracts foreign capital. Today, the DXY dollar index softened considerably, dropping down to 99.70.
Correct. Since physical gold is priced globally in U.S. dollars, a weaker dollar makes gold mechanically cheaper for international buyers holding foreign currencies.
Right. That dynamic drives up international demand and pushes the gold price higher.
Furthermore, our daily desk data shows that gold crossed a major technical resistance level today. When that technical breakout occurred on the charts, it triggered automated systematic buying from massive trend-following funds.
Right. These algorithmic funds buy blindly when resistance lines are broken.
So, counterintuitively, the drop in oil actually became the fundamental catalyst for the surge in gold, which was then heavily amplified by technical trading mechanics.
Understood. If we pull back and look at the broader picture, we have to synthesize this data to answer the ultimate question for you, the listener.
Yeah.
What actual economic regime are we trading in right now? We have crude oil dropping, which is a highly disinflationary signal, but we have the ISM prices paid index spiking to 70.3, which is a highly inflationary signal.
Right.
We have a steepening yield curve and rising term premia in the bond market, yet equities remain pinned near all-time highs, as money merely rotates from technology into defensives rather than cashing out to the sidelines entirely.
Synthesizing this data reveals a market operating in a state of high suppressed anxiety. The equity market is desperately attempting to price in a conditional soft landing.
You mean a Goldilocks scenario where services activity remains highly resilient?
Exactly. And the Hormuz shipping deal mitigates energy inflation just enough to keep the consumer afloat. However, underneath that surface-level optimism, institutional fixed-income capital is terrified of a stagflationary reality. If the ADP employment miss and the ISM employment contraction are accurate leading indicators, the U.S. labor market is objectively slowing down.
But if the ISM prices paid metric continues to climb due to sticky services costs, the Warsh Fed will be entirely cornered.
They will. They'll be forced to maintain highly restrictive interest rates, or potentially even hike rates further to fight off sticky inflation, despite the glaring fact that corporate hiring is stalling out.
That scenario is the textbook definition of stagflation.
It is. This delicate, contradictory balance makes the broader market incredibly vulnerable right now. Investors are rotating capital into defensive sectors like healthcare and materials because they desperately want to stay invested and generate yield.
But they are trying to hide from the macroeconomic risks at the same time.
Ultimately, everything currently hinges on the upcoming July non-farm payrolls report. That single data point will either validate the institutional stagflation fear, or it will provide just enough relief to sustain the soft landing narrative.
Let's quickly recap the three main takeaways from today's briefing so you can effectively position your portfolio.
Sure.
First, we are tracking intense stagflationary tension, highlighted by the ISM prices paid spike directly contrasting with the ADP employment miss. Second, there is a massive structural shift underway in technology equities, moving control away from institutional hedge funds and toward retail options traders due to severe July deleveraging.
Yeah.
And third, we analyze the dual Hormuz-driven moves in the commodity space today, with crude oil selling off on supply optimism while gold surged on shifting rate expectations and algorithmic technical breakouts.
I will leave you with a final forward-looking thought based on today's proprietary updates. With institutional hedge funds permanently stepping back from warehousing mega-cap tech stocks due to their severe July deleveraging, the foundational support for these assets has fundamentally changed.
It really has.
What happens to the broader indices during the next major macroeconomic shock when the cargo ships are gone and only retail options flows remain to catch the falling knives?
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.